It's the inflation, stupid. Remember old James Carville thing when Clinton was running? It's the economy, stupid. Well, it is literally the inflation. I'm going to share with you a blog post I just posted and an email I sent to my subscribers on my email list. So let me read this to you, and we'll go over it a little bit because I also want to show you some of the charts. Inflation is the bugaboo. No other way around that. So I just posted this today. So by all means, go to Heritage Wealth Planning and read. And if you're so kind, if you want to make sure that your old buddy Josh gets paid, if you see an ad up here, just click it. Just click it. I don't know how much they pay me, but if you click it, it pays me. If you don't click it, I'm not sure how it works, frankly. But I have no idea what these ads are. Sometimes they show up. Sometimes they don't. If it's for something that looks interesting, by all means, click it. Oh, here we go. Here's some Coursera stuff. All right. So let's read this. One of my subscribers on YouTube channel sent me this article, Sequence of Return Risk, Decomposing Real Returns into Nominal Returns and Inflation to Find the Real Villain. So let's open this guy. This guy is phenomenal, by the way, my friends. I love Ervan. Oh, man. All right. Hold on. Well, hold on. Let me sign in here real quick. Now I'm no longer on Facebook. It's stuff I used to sign in via Facebook. I have to go and redo it, so it's kind of pain. But anyway, so he talks about the ultimate guide to safe withdrawal rates, part 15, early retirement now. That'd be interesting to look at. I don't know anything about that, but that'd be interesting to check out. I might actually check that out myself. But anyway, this guy right here, man, he's just a treasure trove of quality research. It's nuts. So let's read about this guy. His tagline, learn how to enjoy retirement with charts and graphs. Or retirement in Vietnam with charts and graphs. There you go. Learn how to enjoy early retirement in Vietnam with charts and graphs. So for those of you who are going to the Philippines, Mexico, there's another one too. Philippines, Mexico, Portugal, anything that you're wanting where the cost of living is cheaper, you might want to subscribe to this guy or follow him, at least on Medium. All right, so he's got a lot of stuff in here, just lots of different standard, just statistical stuff, which actually puts a pain in my head, like watching Tom Brady not catch that pass against the Eagles in the Super Bowl. Oh, that didn't cost him the Super Bowl, but man, who knows what it would have been. Or watching Wes Welker not catch that pass against the Giants in the Super Bowl. Oh, I know. Well, if Donovan McNabb didn't get tired, I get it. All right. So I just want to show you a couple times. We know that equities are not correlated with inflation, so mixing up two uncorrelated things muddies the water. In the analysis above, early retirement used real returns, which I think gives misleading results because we know equities are not correlated with inflation. All right, I just want to actually go. So there's no way we're going to follow this stuff, but I do want to show you one thing here. Wait. In other words, sequence of returns only explains 2/3 of your safe withdrawal rates. Remember, up to now, we've ignored inflation. It isn't exactly surprising that we aren't able to fully explain safe withdrawal rates without it. But now we have a better grasp of how important inflation is and how much we should really worry about a big stock crash in the first few years of retirement. I think people, this is this guy, over-worry stock market crashes affecting their retirement and under-worry about inflation. I could not believe that. So right here, I want to share this one with you here real quick. He talks about, hold on just a second, right here. And inflation takes longer to make an impact, but has a long tail. Inflation over the first 12 years of retirement has the same R squared as the equity returns over the first 2 years. But which one do you think retirees worry about most? A stock crash in the first 2 years after retiring, or inflation over a decade? And inflation, this is huge. And inflation over the full 30 years has almost the same R squared as equity returns in the first 4 years. Retirees aren't crazy to worry about a big crash in the first 4 or 5 years of retirement, but they probably shouldn't worry about it as much as they do. Instead, spare some worry for a long period of higher than normal inflation. So basically what he's saying is there's the same risk to running out of money with a long inflation scenario than there is an immediate stock market crash. So let me go into my own talk on this. Let's see. He says inflation is as big concern over your retirement as a retirement to market crash. Unfortunately, we, myself included, focus more on the initial stock market declines, which happen fast and violently, than we do over the slow boil of the frog in the inflationary pot. Yet the slow boil is just as devastating. For use on the podcast, I'm just reading from my own blog post I posted here today. We have all been told that the 30s were the death sentence of a portfolio, the 30s inflation, the Great Depression. Simply not true. My analysis of the Wellington Fund proves this. If you retired in 1930 and pulled 6% a year from the Wellington, adjusted for inflation, your money would have lasted until 1949. It's almost 2 decades, pulling 6% a year out during the Great Depression. But you start that same scenario in 1966, your money would have only lasted to 1979. If you did the same in 1973 and took 6% a year out, adjusted with inflation, you would have been broke by 1987. So let's look at this. So here we're doing 6% a year. We're using the Wellington now. Yep, 6%. So we start with $100,000, taking 6% a year, adjusting with inflation. Now here's the interesting thing. The $6,000 at the start of 1930, you only need to take $4,500 out at the start of 1933 or 34, something like that. And that's where we see you're not taking $6,000 again out until 1943. The deflationary aspect was a saving grace for those withdrawals. You actually took out less each and every year because of the deflationary construct of the Great Depression. So even though the stock market returns getting killed, and for the most part in the beginning of the first couple of years of the 1930s, because you're taking less each year out, it wasn't nearly as devastating. So look, $6,000 a year by the end of 1933 was only $4,500 a year. By the end of 1940, it was only $4,913. You see what I'm saying? But finally, by the end of 1943, it's back up to $6,000. But that 1930. Taking 6% a year out, adjusted for inflation, would have lasted until the middle, about the middle of 1949. Nuts. Now, if we go to here, this is 1966, at $100,000, we would have been out of money by 1970. We ran out of money by the middle of 1979, so 13 years. Come over here, we take 100,000, we start with 100,000, pull 6,000 a year out in 1973, and it's gone by the middle of 1987. So 13, 14 years. But so we did much, much better. We lasted 19 years in the Great Depression, but only 13 and 14 in the 70s. Nuts. Come down here to 2000. This is 2000. We're taking 6,000 a year out, adjusted for inflation. We start with $100,000. At the end of 2018, we still got $91,000 in there. If we started in 2009 or 2008, $100,000, we got killed the first year. We're down 37%. Well, not the Wellington, was down 22%, but we're still sitting on $87,000 at the end of 2018. So while not great, that's certainly better than any of the other years for sure. Isn't that interesting? So what if we did 5% distros? All right, so distros means distributions. I just call it distro for short. So $100,000 a year. We started with $100,000 in 1930. We took $5,000 a year, adjusting for inflation. That money lasted us until 1959. And then we ran out of money. So that's basically 3 decades. And I'm very comfortable with saying that's a good place to be. I'd be willing to hang my hat on that. You'll be just fine. Because I don't expect you to just continue to spend as much as you do when you're 90 years old as when you're 60. But if we go down to 1966 and we took $5,000 a year out, adjusted for inflation, we're done by 1981. And that's what Jeremy Siegel talks about in his book up there, Stocks for the Long Run. The 66 to 82 was just a devastating time for stocks, without question, and bonds. So we ran out of money. If we started in 1973 and we took $5,000 a year out, adjusted to inflation, we ran out of money. We never ran out of money. All right. So again, 66 to 82 was horrible. So if we started in 1973, we started to a pretty significant bear market with pretty significant inflation. The fact that we had money left over come 1982 when the market just galloped, we did fine. We never ran out of money in 1973. That's at 5%. Go back to 2000, and by the end of 2018, we had more than our capital to begin with. And then if we go back to 2008, again, we have more than our capital to begin with. We started with $100,000. It fell to 72,000, but now we're back up to 106. So basically, 5% you did fine, other than the 66 to 82 numbers. And basically, I'm saying the Great Depression, you survived. It's not, you did run out of money, but after 30 years, I'm comfortable with that. And then if we go to 4%, the same thing, except watch this. The old 4% rule, it did not last. 1966, and we're out of money by 1984. So only 18 years of the 4% rule during 66 to 82. So that's when you get crushed. No other way around that. Sad. Let's see. By the end of we talked about this. Okay, well, this exercise has been my Saul on the road to Damascus moment where I've been blinded by the light. Market declines hurt, but inflation kills. And this leads me to challenge the entire premise of typical financial retirement planning. Take out the inflationary period and everything is better. Essentially, 5% is fine. I even do 5.5%. Let's just do 5.5% here. I do 5.5%. Again, this will be my forthcoming book, Retire with Wellington Fund. So 5.5% in the Great Depression would have lasted us until 1952. So that's 22 years. Not quite a retirement, but it's pretty doggone close. I'm somewhat comfortable with that. 1966, 5.5% would have lasted us until 1979. So we're doomed. 1973, 5% would have lasted us until 1987, 88, 89, 90, 91. 91, so that's 18 years as well. So 5.5% is probably a bridge too far. From 2000 to 2018, we have more than what we put in at the end of 2018. And then 2008 to 2018 at 5.5%, we're right about where we started. All right, let's see. Okay, so take out the inflationary period and everything is better. Everything. Unfortunately, if you retired in 1966, you would have not known the calamity that was coming. In 1966, the market declined less than 7%. No big deal there, except that, and particularly because inflation was only 2.6%. So if you retired in 1966, like, market fell 7%, inflation's less than 3%, that's no big deal. 1967 and 1968, the market gave us back roughly 8% a year. In fact, we can look here and go back to the Wellington and see what the markets did in 1966 and 67. And we can see it was up 8.1% in 1967 and 7.9% in 1968, excuse me. So that's no big deal. Inflation 1967 was 3.09. Inflation 1968 was 4.1. But then watch, 5.4, 5.7, drops again, 6.2, 10. That's a problem. But still, in 1967 and 1968, with inflation running around 3% and the market's giving you 8% a year, you're probably thinking you're good to go. All is quiet on the Western Front. Unfortunately, unbeknownst to you, you were actually the frog in the pan of slowly boiling water. Fast forward to today. Markets are down a small amount last year, about 5%. Inflation is low. All is quiet on the Western Front again. But this is where I take extreme issue with President Trump. He is Nixonian in some regard, wanting to devalue the dollar to be able to better compete with foreign competitors in our exports. That only makes sense. Make it in America and sell it overseas. The export economy, which is what it seems like everybody's after. Awful hard to do that, though, with a strong dollar. Awful hard even to sell American-made goods in our own country with a strong dollar when foreign goods are going to be cheaper. Just basic economics. And Trump isn't stupid. He knows to increase demand in our domestic manufactured products, the price needs to go down. To increase the demand, be it at home or out or foreign countries, importing or internally importing or exporting to foreign countries, the price needs to go down relative to other countries. Trump is doing... how do you do this without killing wages, though? How do you drive the prices down without killing wages? Driving the prices down, because the labor is the biggest cost for all these manufacturers. You devalue, which is a weaker dollar, which is Trump has talked about time and again. But remember, devaluation equals inflation. Strong dollar is good, as Steve Forbes has said many, many years, which is why I supported him in 1996. My candidate was Forbes and Harry Brown. I did not support Bob Dole. I don't even think I voted for Bob Dole. But Harry Brown for the Libertarian Party and Steve Forbes for the Republican, but he lost the primary. Weak dollar is bad. Trump is doing the next best thing, actually, putting tariffs on goods coming into the country from countries that are stealing from us, China. But while that ultimately will make China buckle, don't get around that. China is in a world of hurt. If we continue what we're doing, China's done, and that's what makes it great. Just like Reagan with the Soviet Union, even though these idiots and the economic professors and their freaking ivory tower said, Paul Samuelson, the Soviet Union is going to survive, it's going to thrive, it's going to beat us. And the CIA saying the same thing. Reagan knew, and Reagan was right. These guys are wrong, and yet somehow Reagan was a dunce. Crazy. Just like the video I just did, the technocrats, man. The technocrats who sit in their bubbles, you can't listen to them. Manufacturers aren't stupid. even if they're manufactured in China and they got more expensive to bring their products in, what they used to do is they manufacture in China, send it through Mexico because of North American Free Trade Agreement, and they come up to the United States. I mean, we got rooked on that NAFTA, man, and we got rooked. Perot said it. Perot, R.I.P. He was right on. We were all wrong, myself included. And free trade, man. It says North American Free Trade Agreement, so it's free trade. It's good. I believe in Milton Friedman. I'm an economist. Blah, blah, blah. We're all wrong. We got taken to the cleaners. China knew what was going on. Send their crap stuff through Mexico. Let Mexico get rid of the tariffs because North made it free trade, and it's all good, and we got screwed without question. And then, of course, they kept stealing our intellectual property. So Trump is finally trying to crack down on that, thankfully. But it's a trade war. No, it's been a trade war. We just haven't engaged. We've been on the losing end. We're finally fighting back. But manufacturers aren't going to sit there and just keep manufacturing in China. They're going to go to Vietnam, Singapore, Thailand. They simply move their production facilities to more U.S.-friendly countries. And we're right back to where we started. It's still a net gain for us, though. But it doesn't solve the riddle of a strong dollar making imports cheaper. I mean, they're manufacturing in Vietnam, Singapore, Thailand. It's still going to be cheaper to homegrown products because of labor costs. So we need to keep our eye out because while things are good now, a couple executive legislative mistakes could cost us big time inflationary. We know the left's policies are horribly inflationary. That's not debatable, my friends. But the right, a la Nixon, and even the Trumpster, can be alerted to making similar mistakes as well. And ultimately, it's inflation that is the enemy. Nothing else comes close. So keep that in the back of your mind, man. Strong dollar, good. Weak dollar, bad. And even if you like Trump, we don't want a weak dollar. I know it's going to sound good initially. That's what inflation always does. Initially, there's a burst because of cheap products. It's alluring, it's addictive like cocaine, but it always, always ceases, and it always hurts, and it always, always, always fails, leading to mass chaos in financial and economic markets, without question. All right, don't forget to smash. Oh, yeah, by the way, click on my blog. Don't forget to subscribe to my blog thing here. If you don't, just send me an email. I'll get you on there if you're not subscribed already. And of course, if you want to help the brother out, click on some of the ads there, and you might find something you like. All right, we'll see you next time.